Embarking on the journey to secure investment for your dream venture is a transformative endeavor that necessitates a strategic and multifaceted approach. Convincing investors to not only believe in your vision, but also commit financial support is an art that requires a profound understanding of the intricacies involved in the fundraising process. This comprehensive guide is designed to be your compass in navigating the complex landscape of fundraising, offering 5 key strategies along with an in-depth analysis and actionable insights to empower you on your entrepreneurial journey. A deep understanding of the market is a prerequisite for convincing investors of your venture's potential. Dive into the process of conducting thorough market analysis, exploring techniques such as SWOT analysis, competitive intelligence, and market segmentation. Uncover how data-backed insights can bolster your case and showcase your venture's awareness of market dynamics, trends, and opportunities. Number 1. Crafting a compelling narrative. The art of storytelling is a potent tool in the arsenal of every successful entrepreneur. Begin by introducing the protagonists of your narrative, your venture, and the compelling problem it endeavors to solve. Establish an emotional connection by articulating the profound significance of the issue at hand, weaving a narrative that resonates on both personal and societal levels. Share the origin story of your entrepreneurial journey, infusing authenticity, passion, and purpose into the narrative. Develop a clear and captivating storyline that not only captures the attention of potential investors, but also leaves a lasting imprint, transcending the realm of statistics and business jargon. Within this strategy, delve into the psychology of storytelling, understanding how emotions can drive investor decisions. Explore techniques such as framing, metaphorical language, and the power of relatability to create a narrative that not only engages but also persuades. Additionally, address potential pitfalls and provide insights on tailoring your story to various audiences, from angel investors to venture capitalists. Number 2. Thorough market analysis. Investors possess a keen eye for entrepreneurs who not only harbor compelling ideas, but also exhibit a profound understanding of the intricate market landscape in which they intend to operate. To seize their attention, conducting an exhaustive market analysis becomes the cornerstone of your strategy, underscoring your venture's commitment to informed decision-making and strategic positioning. Begin by delving into the intricacies of market analysis, showcasing a comprehensive grasp of industry dynamics. Unveil your understanding of the target audience demographics, exploring not only their needs and preferences, but also their behaviors and expectations. Detail your knowledge of potential competitors, emphasizing their strengths, weaknesses, and market positioning. Employ data-backed insights to substantiate your claims, demonstrating a meticulous approach to market research. Utilize both primary and secondary research methodologies, showcasing the depth of your investigation into market trends, consumer demands, and potential gaps. This foundational knowledge positions your venture as one grounded in reality and tailored to meet genuine market needs. Address the evolving landscape of digital marketing and elucidate how your venture harnesses its power for market validation and investor outreach. Showcase your proficiency in leveraging digital channels to validate market demand through surveys, focus groups, or online engagement. Demonstrate how your digital presence serves as a real-time feedback loop, allowing your venture to stay attuned to market sentiments and trends. Explore how digital marketing extends beyond validation to strategic investor outreach. Detail how your online presence, including a robust website, social media campaigns, and thought leadership content, is curated to resonate with potential investors. Showcase success stories or key metrics derived from digital marketing efforts that indicate not only market acceptance, but also investor interest. Number 3. Developing a robust business plan. A meticulously crafted business plan serves as the navigational chart for your venture's journey. Outline your business's vision, mission, and objectives with clarity and precision. Break down financial projections, elucidating revenue streams, cost structures, and scalable growth strategies. Address potential challenges and risks while presenting comprehensive mitigation plans. A robust business plan not only instills confidence in investors regarding your strategic acumen, but also provides them with a tangible framework to understand how their investment will contribute to the success of your venture. Within this strategy, explore the nuances of financial modeling, emphasizing cash flow management and showcasing the scalability of your business model. Address the importance of scenario planning in mitigating risks and adapting to unforeseen challenges. Uncover the intricacies of presenting a business plan, including effective visual aids, executive summaries, and post-presentation follow-ups. Number 4. Showcasing traction and milestones. Investors seek assurance that their funds will be invested in a venture with tangible progress and significant potential. Showcase key milestones and achievements that reflect the traction your venture has gained. Whether it's user acquisition metrics, successful pilot programs, or noteworthy partnerships, tangible evidence of progress adds substantial credibility to your pitch. Provide comprehensive data that reflects the growth trajectory of your venture, assuring investors that their capital will contribute to an already proven and promising journey. Within this strategy, delve into the metrics that matter most to investors, exploring customer acquisition cost, CAC, customer lifetime value, CLV, and other key performance indicators, KPIs. Discuss strategies for effective pilot programs, emphasizing iterative testing and feedback implementation. Address the importance of data transparency, showcasing not only successes, but also lessons learned from setbacks. Number 5. Building a strong team and network. Investors are astutely aware that behind every great idea, it is the team that ultimately determines the success of a venture. In this critical aspect of fundraising, showcasing your team's skills, experiences, and unwavering dedication becomes a pivotal strategy. This involves highlighting key team members, elucidating their roles, and emphasizing their expertise and past successes. A robust, cohesive team not only enhances your venture's credibility, but also serves as a powerful indicator of its ability to navigate challenges and drive success. Mentorship plays a crucial role in personal and professional growth. Discuss how mentorship is integrated into your team dynamics, whether through formal mentorship programs or informal relationships. Highlight success stories of mentorship within your team, demonstrating the positive impact it has had on individual development and overall team cohesion. Networking is a valuable asset in the business world. Elaborate on how your team strategically leverages its professional network to garner support, mentorship, and potential introductions to investors. Showcase instances where networking has played a pivotal role in opening doors or creating opportunities for your venture. Detail the strategic approach your team takes to leverage its network for investor support. Discuss how connections within your network have provided valuable insights, guidance, or even direct introductions to potential investors. Showcase any endorsements or testimonials from individuals within your network, reinforcing the credibility and trustworthiness of your team. Highlight instances where your network has facilitated access to resources, expertise, or mentorship that directly contributed to the success and growth of your venture. Articulate your team's ongoing commitment to nurturing and expanding this network, recognizing it as a dynamic asset that continuously fuels the momentum of your entrepreneurial journey. In conclusion, securing investment for your dream venture is a comprehensive and dynamic process that requires a strategic blend of storytelling, market analysis, business planning, showcasing traction, and building a robust team and network. This guide aims to equip you with a detailed understanding of each strategy, offering actionable insights and advanced techniques to elevate your approach. Remember, the journey to securing investment is not merely about acquiring funds. It's about building lasting partnerships that elevate your entrepreneurial vision to new heights. Building substantial wealth is a goal that many individuals aspire to achieve, and understanding the strategies employed by the rich can provide valuable insights for those starting from scratch. While the journey to financial success is unique for everyone, some common principles and strategies have been employed by wealthy individuals to multiply their wealth. In this comprehensive exploration, we will delve into 5 key strategies rich people use to amass and multiply their wealth, offering practical tips and insights for those who are embarking on their wealth-building journey. Number 1. Strategic investing, diversification, and risk management. Delving into the intricate world of strategic investing, rich individuals employ a meticulous approach that stands as the cornerstone of their wealth multiplication journey. Within this strategy lies a profound understanding of diversification and risk management. Picture this: a wealthy investor as a masterful conductor orchestrating a symphony of investments. These individuals carefully distribute their funds across a diverse array of investment vehicles, from the bustling stock markets to the solid foundations of real estate, the stability of mutual funds, and the innovation of budding businesses. Diversification, The magician's wand in this financial orchestra ensures that their wealth is not a delicate house of cards, relying on a single asset or market stability. Instead, it's a robust fortress, fortified against economic tempests. By spreading their investments like a net cast wide in the ocean of opportunities, they shield themselves from the caprices of any single investment's poor performance. Their strategy mirrors a skilled chef blending a variety of ingredients to create a masterpiece: a dash of stocks, a pinch of real estate, and a generous dollop of entrepreneurial ventures. Yet, it's not merely about scattering investments randomly. It's a calculated ballet, a strategic waltz designed to maximize returns while minimizing risks. This thoughtful dispersion ensures that their financial fate isn't tied to the unpredictable rise or fall of one solitary star in the investment galaxy. Their portfolio, akin to a diverse ecosystem, thrives because it's not dependent on the fortune of a sole species, but rather a vibrant tapestry of interconnected opportunities. Number 2. Continuous learning and financial education. In the realm of wealth creation, rich individuals grasp a fundamental truth. Knowledge is the linchpin upon which financial empires are built. They understand that in the dynamic landscape of finance, staying ahead of the curve is not a luxury but a necessity. Thus, they embark on an unending journey of self-improvement through continuous learning and financial education. Imagine these individuals as avid explorers, tirelessly charting the ever-changing terrain of market trends and investment landscapes. Their thirst for knowledge knows no bounds, leading them to diverse avenues of learning. They attend seminars, not as passive spectators, but as active participants absorbing every nugget of wisdom. They immerse themselves in books, where the wisdom of seasoned investors and financial wizards becomes their guiding light. In the digital age, they harness the power of technology, enrolling in online courses that serve as portals to a universe of financial expertise. This commitment to perpetual learning is their secret weapon, their shield against ignorance in the vast battlefield of investments. Armed with a deep understanding of market dynamics and financial intricacies, they are equipped to make decisions that are not just educated guesses, but well-informed choices rooted in expertise. This knowledge isn't merely a collection of facts, it's a powerful tool that sharpens their analytical acumen and refines their instincts. Number 3. Multiple streams of income, creating financial stability. In the intricate tapestry of wealth creation, the rich have woven a pattern of financial stability through the art of diversifying income streams. They understand that relying solely on a solitary source of income in today's volatile economic landscape is akin to building a house on shifting sands, precarious and vulnerable. Thus, they embark on a journey to cultivate multiple streams of revenue, transforming their financial lives into a resilient ecosystem. Imagine these multiple income streams as the roots of a mighty tree, drawing nourishment from various sources. Rich individuals don't confine themselves to the limited scope of a single paycheck. Instead, they nurture a diverse garden of financial opportunities. Investments, businesses, royalties, and passive income streams are the branches of this flourishing tree. Each branch bears fruits of financial security and peace of mind. Diversifying income streams is not a mere strategy. It's a philosophy that acknowledges the unpredictable nature of the world we live in. By weaving a web of varied income sources, the rich create a safety net that shields them from the storms of economic uncertainty. When one stream faces a temporary drought, others continue to flow, ensuring a continuous influx of funds. This financial safety net not only offers stability, but also provides the freedom to explore new investment ventures without fear of jeopardizing one's entire financial security. Number 4. Frugality and prudent spending, maximizing savings. Contrary to the extravagant image often associated with the wealthy, many affluent individuals exhibit a surprising trait: frugality. They possess a profound understanding of the value of money and exercise careful judgment in their spending habits. Despite having the financial means to splurge on luxuries, they consciously make prudent financial choices. Budgeting, avoiding unnecessary expenses, and maintaining a lifestyle well within their means are principles they steadfastly uphold. This disciplined approach allows them to amass significant savings, serving as the building blocks for their investments. Embracing a frugal lifestyle is not a mere practice, it's a philosophy that underpins their financial decisions. By curbing unnecessary expenditures, they channel substantial funds into their savings, creating a robust financial cushion. This disciplined saving paves the way for investments, acting as the fuel that drives their wealth multiplication endeavors. 5. Networking and mentorship. Learning from the experts. Networking and mentorship stand as invaluable pillars in the arsenal of strategies utilized by the wealthy to amplify their wealth. Successful individuals comprehend the paramount importance of surrounding themselves with kindred spirits and ambitious minds. They actively pursue mentors, seasoned individuals who have attained significant financial success, and glean insights and wisdom from their experiences. Mentors serve as guiding lights, offering priceless advice, unlocking doors to unexplored opportunities, and illuminating the path to prosperity. In the realm of networking, ideas flow like a river, collaboration becomes fertile ground, and access to potential business ventures is boundless. By fostering a robust network and embracing mentorship, individuals gain access to a treasure trove of knowledge and unwavering support. This network becomes a reservoir of inspiration, innovation, and shared aspirations, propelling individuals closer to their financial ambitions. Through these connections, dreams transform into tangible realities, and ambitions find the wings to soar. In essence, networking and mentorship not only open doors but create pathways, bridging the gap between potential and achievement. In the pursuit of building wealth from scratch, adopting the strategies employed by rich individuals can significantly enhance one's chances of success. Strategic investing, continuous learning, creating multiple streams of income, practicing frugality, and embracing networking and mentorship are not just abstract concepts, but actionable steps that can be incorporated into one's financial journey. Each of these strategies contributes uniquely to the process of wealth multiplication, providing a roadmap for individuals to follow. Ultimately, building wealth is not solely about the accumulation of money, but also about cultivating a mindset of financial responsibility, discipline, and strategic thinking. By integrating these strategies into their lives, individuals can embark on a transformative journey toward financial abundance, laying the groundwork for a secure and prosperous future. Building and growing wealth through strategic investments is a journey that requires careful planning, discipline, and a long-term perspective. Here, we'll delve into 10 comprehensive tips that can help you not only accumulate wealth, but also sustain a lifestyle supported by your investments. First and foremost, it's crucial to establish clear financial goals. Whether it's saving for retirement, purchasing a home, or funding your child's education, having specific objectives provides direction to your investment strategy. This clarity enables you to tailor your portfolio to meet your unique needs and timelines. Diversification is a fundamental principle that can't be emphasized enough. Spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities, helps mitigate risks associated with the volatility of individual markets. A diversified portfolio is better positioned to weather market fluctuations and deliver more stable returns over the long term. While diversification is key, it's equally important to periodically review and rebalance your portfolio. Market conditions and asset values can change, and adjustments may be necessary to maintain your desired risk-return profile. Regular assessments ensure that your investments align with your goals and risk tolerance, preventing any unintended concentration in specific assets. Investing requires patience, and adopting a long-term mindset is essential. Timing the market is notoriously difficult, and short-term fluctuations are inevitable. Instead of succumbing to the temptation of chasing quick gains, focus on the compounding power of your investments over time. This approach allows you to harness the full potential of your assets and benefit from the exponential growth that comes with sustained, patient investing. Delving into the world of investment requires a solid understanding of various financial instruments and strategies. Begin by familiarizing yourself with stocks, which represent ownership in a company and can offer capital appreciation and dividends. Bonds, on the other hand, are debt securities issued by governments or corporations, providing regular interest payments and returning the principal at maturity. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets, offering a convenient way to achieve instant diversification. Beyond these basics, explore other investment vehicles like exchange-traded funds, ETFs, real estate investment trusts, REITs, and options. ETFs are similar to mutual funds but trade on stock exchanges, providing flexibility and liquidity. REITs allow you to invest in real estate without directly owning physical properties, offering dividends from rental income and capital gains. Options provide the right, but not the obligation, to buy or sell an asset at a predetermined price, adding a layer of flexibility to your investment toolkit. To make informed decisions, stay informed about market trends, economic indicators, and financial news. Follow key indicators like GDP growth, unemployment rates, and inflation, as they can impact the overall market and specific sectors. Understand how interest rates influence investment returns and how geopolitical events may affect global markets. Regularly reading financial news and analysis from reputable sources can provide valuable insights into market sentiment and potential opportunities or risks. Costs matter in investing, and minimizing fees and expenses can significantly impact your overall returns. Choose low-cost investment vehicles, such as index funds and exchange-traded funds, ADS, to reduce the drag of fees on your portfolio. Additionally, be mindful of taxes and explore tax-efficient investment strategies to maximize your after-tax returns. Compounding growth is akin to a financial snowball gaining momentum as it rolls downhill. Your initial contributions earn returns, and as those returns get reinvested, they too start generating additional returns. This compounding effect amplifies the growth potential of your investments over time. The earlier and more consistently you contribute, the more time your money has to benefit from this compounding magic. Now, let's talk about automation. Setting out automated contributions is akin to putting your wealth building on autopilot. By scheduling automatic transfers to your investment accounts, you create a seamless and disciplined approach to growing your wealth. This not only eliminates the need for constant manual intervention, but also ensures that you stay committed to your financial goals, regardless of life's inevitable distractions. Automation brings a level of consistency and reliability to your financial strategy. Life can be hectic, and it's easy to forget or postpone manual contributions. Automated transfers help overcome this challenge, fostering a systematic approach to wealth accumulation. They turn saving and investing into a habit, ingrained into your financial routine. Consider it as a financial set-it-and-forget-it approach. With automation, you're less likely to be swayed by short-term market fluctuations or tempted to deviate from your long-term financial plan. This steadfast commitment, combined with the compounding power of regular contributions, forms a formidable duo in the journey towards building enduring wealth. In summary, regularly contributing to your investment accounts, even in modest amounts, is a cornerstone of financial success. Pairing this with automated contributions elevates your approach, instilling discipline and ensuring that your wealth-building journey remains on a steady and upward trajectory over time. Emergency funds are a crucial component of any financial plan. Having a readily accessible pool of funds can prevent the need to liquidate investments during unexpected expenses or market downturns. Aim to maintain 3 to 6 months' worth of living expenses in a liquid and easily accessible account to provide a financial safety net. Reinvesting dividends and interest can accelerate the growth of your investments. Instead of cashing out these distributions, consider reinvesting them back into your portfolio. This compounding effect can have a substantial impact on the overall performance of your investments, particularly over extended periods. When you choose to reinvest dividends and interest, you're essentially putting your earnings back to work. Rather than receiving these payouts as cash, you use them to acquire additional shares or securities within your portfolio. This not only increases the size of your investment, but also sets the stage for even more earnings in the future. The compounding effect of reinvesting is akin to planting seeds that grow into a lush financial garden. The additional shares or securities you acquire through reinvestment start earning their own dividends and interest, which in turn can be reinvested. It's a cycle of growth that gains momentum over time, creating a snowball effect of wealth accumulation. This strategy is particularly potent when viewed through the lens of long-term investing. Over extended periods, the compounding effect can lead to exponential growth. The more consistently you reinvest, the more pronounced the impact becomes. It's a strategic approach that aligns with the adage, the most powerful force in the universe is compound interest. Moreover, reinvesting dividends and interest provides a form of automatic wealth building. It's a hands-off way to fortify your portfolio without requiring additional effort on your part. This automated compounding not only amplifies the growth potential of your investments, but also reinforces a disciplined and patient approach to wealth accumulation. In essence, by choosing to reinvest, you're harnessing the dual power of compounding, both in the initial contributions you make and in the additional contributions generated by the reinvested earnings. This dynamic strategy can play a pivotal role in elevating the long-term success of your investment portfolio, turning it into a wealth-generating engine that steadily grows and compounds over time. Lastly, seek professional advice when needed. Consulting with a financial advisor can provide personalized guidance based on your specific financial situation and goals. An advisor can help you navigate complex financial markets, develop a customized investment strategy, and adapt to changing circumstances. In conclusion, growing wealth and living off investments is a multifaceted process that requires a combination of strategic planning, disciplined execution, and continuous learning. By setting clear goals, diversifying your portfolio, maintaining a long-term perspective, and incorporating these 10 tips into your approach, you can build a robust financial foundation that supports a prosperous and sustainable lifestyle. In the dynamic landscape of 2024, saving money has become more crucial than ever, with economic uncertainties and rapidly changing financial scenarios. Adopting smart and strategic approaches to savings is essential for individuals seeking financial stability and prosperity. In this era of technological advancement, one of the first and foremost ways to enhance your savings strategy is by leveraging digital tools and apps for budgeting and expense tracking. With the plethora of applications available, individuals can gain real-time insights into their spending patterns, identify areas for potential savings, and make informed financial decisions. Setting clear and realistic financial goals is another fundamental step in the savings journey for 2024. Whether your objectives include building an emergency fund, saving for a down payment on a home, or contributing to your retirement nest egg, having specific and measurable goals provides direction and motivation. By breaking down larger financial aspirations into smaller, achievable milestones, individuals can create a roadmap for effective savings. This approach not only helps prioritize financial objectives, but also enables regular assessment of progress and adjustment of strategies as needed. Automation remains a powerful tool for consistent and disciplined saving. In 2024, consider setting up automated transfers to your savings account or investment portfolio. Automation removes the temptation to spend impulsively and ensures that a portion of your income is allocated towards savings before you have a chance to use it elsewhere. This hands-off approach to savings is particularly effective for those who find it challenging to manually set aside money regularly. By embracing automation, individuals can build a habit of saving effortlessly, contributing to long-term financial success. Exploring new investment opportunities is a key aspect of optimizing savings in 2024. The financial landscape is ever-evolving, and staying informed about potential investment avenues can lead to more robust returns. Whether it's diversifying your investment portfolio, exploring emerging markets, or considering sustainable investing options, being proactive in understanding and adapting to the changing investment climate is crucial. Sustainable investing, in particular, has gained prominence, allowing individuals to align their financial choices with their values while potentially benefiting from the growing emphasis on environmentally conscious practices. In the evolving landscape of financial decision-making, environmental consciousness is emerging as a pivotal factor, shaping the choices individuals make with their money. In 2024, it is increasingly important for individuals to consider incorporating eco-friendly practices into their savings and investment strategies. This shift towards sustainability is not only driven by a growing awareness of environmental issues, but also by the recognition that aligning financial decisions with ethical and environmental values can have positive implications for both society and personal wealth. Sustainable investing is a prominent avenue for individuals looking to integrate environmental consciousness into their financial portfolios. This approach involves directing funds towards companies and projects that adhere to environmental, social, and governance (ESG) criteria. By supporting businesses that prioritize sustainability, individuals can play a role in fostering positive societal impacts. Moreover, sustainable investing isn't just about altruism, it also offers opportunities for financial growth. Companies embracing eco-friendly practices are often well-positioned to thrive in a world increasingly valuing environmental responsibility. Investing in such enterprises can potentially yield favorable returns while contributing to a more sustainable future. Beyond investment strategies, adopting a more environmentally friendly lifestyle is another way individuals can align their financial choices with a broader commitment to sustainability. This could involve simple yet impactful actions, such as reducing energy consumption in the home or choosing products with eco-friendly certifications. While these lifestyle changes may seem modest, they can accumulate into substantial cost savings over time. For instance, energy-efficient appliances and practices not only contribute to environmental conservation, but also lead to reduced utility bills, directly benefiting one's financial bottom line. In essence, the call for environmental consciousness in financial decisions is a recognition of the interconnectedness of economic activities with environmental and social well-being. By incorporating sustainable practices into savings and investment strategies, individuals contribute to a positive global impact. They become agents of change, influencing corporate behavior towards more responsible and sustainable practices. Simultaneously, embracing an environmentally friendly lifestyle offers a personal sense of fulfillment as individuals witness the tangible benefits of their choices while promoting a more sustainable and resilient financial future for themselves and future generations. In the financial landscape of 2024, taking full advantage of employer benefits emerges as a pragmatic and strategic approach to augmenting savings. Many employers recognize the importance of supporting their employees' financial well-being and, as part of their benefits package, offer a range of opportunities that can directly contribute to individual savings and overall financial health. One key aspect of employer benefits is the provision of retirement plans, such as a 401k. Contributing to these employer-sponsored retirement plans not only offers individuals a convenient method for saving for their post-employment years, but also comes with notable tax advantages. Contributions to a 401k are typically made on a pre-tax basis, meaning that the amount contributed is deducted from the individual's taxable income. This immediate tax benefit reduces the individual's taxable income for the year, potentially lowering their overall tax liability. Furthermore, the funds invested in a 401k have the opportunity to grow over time through compounding, enhancing the potential for wealth accumulation. Health savings accounts, HSAs, are another valuable component of employer benefits, particularly in the context of rising healthcare costs. HSAs allow individuals to set aside funds for qualified medical expenses on a tax-advantaged basis. Contributions to HSAs are made on a pre-tax basis, offering a similar tax advantage as contributions to retirement plans. Additionally, the funds in an HSA can be invested, potentially growing over time. What sets HSAs apart is their flexibility. Individuals can use the funds to cover current medical expenses or choose to let the money accumulate and invest for future healthcare needs. This flexibility makes HSAs a versatile tool in managing both immediate healthcare costs and long-term health-related expenses. In summary, successfully managing finances in 2024 demands a proactive and flexible approach to savings. The contemporary financial landscape is marked by rapid changes and uncertainties, making it imperative for individuals to adopt strategic measures. Leveraging technology for budgeting serves as a foundational step, allowing real-time insights into spending patterns and enabling informed financial decisions. Setting clear financial goals is crucial, providing direction and motivation for effective savings. Embracing automation, such as automated transfers to savings accounts, ensures consistency and discipline in saving, reducing the likelihood of impulsive spending. Exploring new investment opportunities reflects an awareness of the evolving financial climate. Diversifying portfolios, exploring emerging markets, and engaging in sustainable investing are ways to optimize returns and align investments with personal values. Sustainability, both in investments and lifestyle, is increasingly significant in 2024, with environmentally conscious choices not only contributing to positive societal impacts, but also potentially offering financial benefits. Maximizing employer benefits is a practical aspect of effective savings. Investing can be a daunting task, often accompanied by a plethora of choices, risks, and uncertainties. While many people venture into the world of investments with high hopes of financial gain, they often make critical mistakes that can lead to substantial losses. One common mistake is lack of research and knowledge. Lack of research and knowledge is a critical mistake often made by novice investors, and it can have detrimental consequences for their financial well-being. When individuals venture into the complex world of investments without a solid understanding of fundamental concepts, they essentially navigate blindfolded through a maze of financial options. Without awareness about the diverse types of assets available, ranging from stocks and bonds to real estate and cryptocurrencies, they lack the necessary insight to make informed decisions. Additionally, not understanding their own risk tolerance, the level of risk they are comfortable with, can lead to investments that are either overly conservative, potentially hindering potential gains, or excessively aggressive, exposing them to unnecessary risks. In the absence of adequate knowledge, investors become susceptible to impulsive decision-making. They might fall prey to market rumors, react emotionally to short-term fluctuations, or rely on unreliable sources of information. This impulsiveness can lead them to make hurried investment choices without thoroughly evaluating the risks and rewards. For instance, driven by a sudden surge of enthusiasm or fear due to a market trend, they might buy or sell assets hastily, often at unfavorable prices. Emotions like fear and greed can cloud judgment, causing them to ignore long-term considerations and focus on immediate gains or losses. Number 2. Overconfidence. Overconfidence represents a significant pitfall in the world of investments, affecting even seasoned investors who have experienced initial success in the market. When individuals achieve early gains, they often develop an unwarranted belief in their ability to predict market movements accurately. This overconfidence can be perilous, as it leads them to underestimate the complexities of the financial markets and overestimate their own capabilities. Consequently, they start taking excessively high risks, assuming they can beat the market consistently. This overconfidence-driven behavior manifests in several detrimental ways. First, overconfident investors may dismiss warning signs and downplay potential risks, believing their judgment is superior to market fluctuations. They might overlook crucial market indicators, economic signals, or geopolitical events that could impact their investments adversely. Second, and equally damaging, overconfident investors tend to neglect the principle of diversification. Diversifying a portfolio by spreading investments across different assets and sectors is a fundamental risk management strategy. However, overconfident investors might concentrate a significant portion of their investments in a single asset or a specific market sector. By doing so, they expose themselves to higher levels of volatility and potential losses if that particular asset or sector experiences a downturn. Number 3. Emotional decision-making. Emotional decision-making stands as a formidable adversary in the realm of investments, influencing choices and outcomes more profoundly than many investors realize. Human emotions, particularly fear and greed, wield significant power, often clouding rational judgment and prompting impulsive actions. In times of market downturns, fear can grip investors, causing them to panic and hastily sell their assets. This fear-driven behavior can result in locking in losses, as these investors fail to withstand the emotional pressure and lack the patience required for the market to potentially rebound. On the flip side, greed can lead investors into risky territories. Driven by the desire for high returns, they might overlook or underestimate the associated risks. This over-optimism can push them towards speculative or volatile investments that don't align with their overall financial goals or risk tolerance. Succumbing to these emotional triggers often leads to poor investment decisions, disrupting long-term strategies and eroding potential gains. Recognizing the influence of emotions on decision-making and developing the discipline to counteract these impulses is crucial for investors to maintain a balanced and informed approach, allowing them to make decisions based on logic and analysis rather than succumbing to the erratic sway of emotions. Another mistake that investors commonly make is market timing. Market timing is a tempting yet treacherous endeavor that many investors undertake, often to their detriment. The concept revolves around trying to predict the ideal moments to buy or sell assets within the financial markets. This practice is commonly driven by short-term fluctuations, news events, or economic indicators that investors believe can provide a competitive advantage. However, accurately forecasting market movements consistently is an elusive goal, even for seasoned financial professionals. One of the significant challenges with market timing is that it requires both pinpointing when to exit the market before a downturn and re-entering when conditions are favorable for growth. The difficulty lies in the unpredictability of market dynamics, as they are influenced by a multitude of factors, including economic data, geopolitical events, investor sentiment, and more. As a result, attempting to time the market often leads to missed opportunities and increased trading costs. When investors attempt to predict market turns, they may find themselves sitting on the sidelines when markets experience unexpected gains. Moreover, the frequent buying and selling associated with market timing strategies can lead to higher transaction costs, which can erode overall returns. These costs can include brokerage fees, taxes on realized gains, and the bid-ask spread, all of which reduce the profitability of an investment portfolio. Number 5. Neglecting to diversify is a fundamental mistake that can have severe consequences. Diversification, the strategy of spreading investments across different asset classes, sectors, and geographic regions, is essential for managing risk. Investors who put all their money into a single type of asset or a specific market sector face significant risks if that asset or sector performs poorly. Diversification helps mitigate the impact of a poor-performing investment on the overall portfolio, enhancing the potential for stable long-term returns. Number 6. Ignoring the impact of fees and expenses. Overlooking the impact of fees and expenses ranks among the most overlooked yet profoundly impactful mistakes made by investors. Many individuals fail to fully comprehend the implications of management fees, transaction costs, and various other expenses associated with their investments. While these fees might seem inconsequential in the short term, their cumulative effect can significantly erode investment returns over time. Management fees, charged by mutual funds, ETFs, and other managed investment vehicles, are calculated as a percentage of the assets under management and can substantially reduce the overall profits earned from investments. Number 7. Failure to have a clear investment plan. It is a mistake that leaves investors directionless and susceptible to impulsive decisions. Without a well-defined investment plan that outlines financial goals, risk tolerance, and a diversified strategy, investors are more likely to make decisions based on short-term market movements or external influences. A clear investment plan provides a roadmap, helping investors stay focused on their objectives and avoid making hasty, emotion-driven choices that can negatively impact their financial future. In conclusion, avoiding these common investment mistakes requires education, discipline, and a long-term perspective. Investors should prioritize continuous learning, conduct thorough research, and seek advice from financial professionals to make informed decisions. Embracing a diversified approach, managing emotions, and having a well-defined investment plan are key steps toward building a successful investment portfolio. By being aware of these pitfalls and taking proactive measures to avoid them, investors can significantly improve their chances of achieving their financial goals and securing a stable financial future. Investing wisely is a crucial aspect of achieving financial security and growth. As we enter the year 2024, the investment landscape is evolving rapidly due to changing economic conditions, technological advancements, and global events. To navigate this complex terrain successfully, it's essential to adopt a strategic and informed approach. In this comprehensive guide, we will explore various aspects of making smart investments in 2024, including understanding the economic landscape, diversification strategies, emerging investment opportunities, and risk management techniques. Understanding the economic landscape. Number 1. Global economic outlook. In order to make prudent investment choices in 2024, it is imperative to possess a comprehensive comprehension of the global economic scenario. Monitoring pivotal indicators like GDP growth, inflation rates, and interest rates is essential as these factors wield substantial influence over diverse asset categories. In the upcoming year, analysts anticipate a sustained rebound from the adverse effects of the COVID-19 pandemic. However, it is crucial to remain vigilant due to potential complications arising from geopolitical tensions and disruptions in the supply chain. These factors could introduce significant volatility into the market, making it essential for investors to stay well-informed and adaptable in their strategies. By keeping a close watch on these economic indicators and being mindful of the external factors at play, investors can make well-informed decisions, navigate uncertainties, and optimize their investment portfolios in the dynamic landscape of 2024. Number 2. Inflation and its implications. Inflation, a critical concern for investors in 2024, holds significant implications for financial portfolios. When inflation rates surge, the actual purchasing power of money diminishes over time. This erosion of real value impacts the returns on conventional investments such as bonds and savings accounts, rendering them less lucrative. In light of this, astute investors are advised to diversify their portfolios by considering assets that historically fare well in inflationary environments. Real estate investments often appreciate in value during inflationary periods, offering a hedge against rising prices. Similarly, commodities like gold and oil tend to maintain or increase their value as the cost of goods rises. Additionally, stocks of companies with pricing power, meaning they can adjust their product prices to match inflation, are considered resilient investments. By strategically allocating resources into these assets, investors can potentially safeguard their wealth and mitigate the adverse effects of inflation on their investment returns in the challenging economic landscape of 2024. Diversification strategies. Number 3. Asset allocation. Asset allocation stands as a fundamental principle in prudent investing strategies. As we approach 2024, it is paramount for investors to meticulously evaluate their investment portfolios and diversify their assets. Diversification, the practice of spreading investments across various types of assets, helps in mitigating risks and maximizing potential returns. It is advisable to strike a balance between different asset classes, such as equities, stocks, fixed income securities, bonds, real estate properties, and even alternative investments like cryptocurrencies. Each asset class carries its own set of risks and rewards, and by blending them strategically, investors can create a resilient portfolio that can weather fluctuations in the market. Equities offer the potential for high returns but come with higher volatility, while fixed income securities provide stability and regular income. Real estate investments often appreciate over time and offer a hedge against inflation. Exploring alternative investments like cryptocurrencies, although volatile, can add a layer of diversification and potential growth. Number 4. The role of bonds. The role of bonds in investment strategies has long been established as a safeguard against the unpredictability of the stock market. Bonds offer stability and regular income, making them a popular choice for risk-averse investors. However, in the context of the potential rise in interest rates anticipated in 2024, a revaluation of bond investments is crucial. When interest rates climb, the value of existing bonds often decreases, posing a challenge for investors. In such a scenario, opting for short-duration bonds becomes prudent. These bonds have a shorter maturity period, which means their prices are less affected by interest rate fluctuations, offering a degree of protection against potential losses. Additionally, considering inflation-protected bonds is advisable. These bonds, as the name suggests, are designed to combat the eroding effects of inflation. They adjust their principal value in response to inflation rates, ensuring that investors receive returns that keep pace with the rising cost of living. Emerging investment opportunities. Number 5. Cryptocurrencies and digital assets. The landscape of cryptocurrencies and digital assets is undergoing rapid transformation, making them a compelling consideration for investors in 2024. In this dynamic environment, it is prudent to allocate a portion of your investment portfolio to cryptocurrencies such as Bitcoin and Ethereum. Despite their reputation for high volatility, these digital assets have demonstrated remarkable growth potential over the years. Bitcoin, as the pioneer in the cryptocurrency realm, and Ethereum, known for its smart contract capabilities, have garnered substantial attention from both individual and institutional investors. What makes these digital currencies intriguing is their decentralized nature, offering a potential hedge against traditional financial market fluctuations. Number 6. Renewable energy investments. The push for sustainability and green energy presents promising investment opportunities. Consider investing in renewable energy companies, solar and wind projects, or green infrastructure funds. Governments worldwide are also offering incentives and subsidies in this sector. Number 7. Tech and innovation stocks. Technology and innovation remain at the forefront of investment opportunities. Companies involved in artificial intelligence, biotechnology, electric vehicles, and 5G technology are expected to continue their growth trajectory. Conduct thorough research to identify promising tech stocks and funds. Risk management techniques. Number 8. Risk assessment and tolerance. Before making any investment decisions, assess your risk tolerance. Your risk tolerance should align with your financial goals and investment horizon. It's essential to strike a balance between risk and potential returns. Number 9. Dollar cost averaging. To mitigate the impact of market volatility, consider a dollar cost averaging strategy. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. Over time, this approach can reduce the effects of market fluctuations. Number 10. Stop-loss orders. Implementing stop-loss orders can help limit potential losses in your portfolio. These orders automatically sell a security when it reaches a predetermined price level. While they don't guarantee protection against all losses, they can help minimize downside risk. Investing in 2024 requires a comprehensive understanding of the economic landscape, a diversified portfolio, and risk management strategies. By staying informed about global economic trends, exploring emerging opportunities, and aligning your investments with your financial goals, you can make smart investment decisions in the ever-changing financial markets. Remember that investment decisions should be tailored to your unique circumstances and risk tolerance, and it's often advisable to consult with a financial advisor for personalized guidance. With careful planning and a disciplined approach, you can work towards achieving your financial objectives in 2024 and beyond.
Have you ever wondered how the wealthy seem to grow their wealth effortlessly? It's a question that fascinates many, and for good reason. The art of managing one's wealth, after all, is an intriguing and essential skill. Well, you're about to discover the secret today. Wealth management is not a skill we're born with, but one we acquire. Picture the world of finance as an ocean, vast and deep. Wealth management is like learning to navigate this ocean, mastering the currents and charting your course to treasure. This concept is about more than just managing money. It's about strategically planning, carefully investing, and diligently growing your assets. It's about creating a roadmap for your financial journey, helping you reach your desired destination, whether it's a comfortable retirement, a legacy to leave your loved ones, or the freedom to pursue your passions. Wealth management is a critical skill set in today's world. Why, you may ask? Consider this. In the global economic landscape, fortunes can rise and fall in the blink of an eye. Without the right strategies and tools, your hard-earned wealth could evaporate before your very eyes. But fear not. Wealth management is not some arcane art known only to Wall Street wizards. It's a learned skill, much like learning to cook or play a musical instrument. And just like those skills, it requires patience, practice, and a bit of guidance. The good news is, you're not alone in this journey. There are countless resources and experts ready to help you navigate the financial seas. Think of them as your compass, your map, your guiding star in the vast ocean of finance. So, how does one acquire this skill? Let's delve into a success story. Meet Jack, an ordinary individual with an extraordinary story. Jack was born into a family of modest means. His parents, hardworking folks, taught him the value of $1 early on. Jack, however, was not content with just making ends meet. He dreamt of financial freedom, of a life where money was not a constant worry. As Jack grew older, his desire to achieve financial abundance drove him into the world of wealth management. He was not a financial wizard, nor did he have a degree in finance. What Jack had, however, was an insatiable curiosity and a determination to learn. He spent countless nights poring over books, attending seminars, and speaking to financial advisors to understand the intricacies of wealth management. But the journey was anything but smooth. Jack faced numerous struggles along the way. He made investments that failed, lost money in the stock market, and even faced bankruptcy at one point. But each failure was a lesson learned. Jack understood that wealth management was not about making quick money, but about understanding the long-term game. His perseverance paid off. Jack slowly but surely started building his wealth. He diversified his investments, created a solid emergency fund, and started saving for his retirement. He was no longer living paycheck to paycheck. Jack was finally experiencing the financial freedom he had dreamt of. But Jack didn't stop there. He used his newfound knowledge to help others in his community. He started a financial literacy program, providing others with the tools and knowledge to manage their wealth effectively. Jack's success story became an inspiration for many, proving that with the right knowledge and mindset, anyone could achieve financial freedom. Jack's wealth didn't grow overnight. It was the result of effective wealth management. He had transformed from an ordinary individual into an extraordinary wealth manager. Jack's story is a testament to the power of perseverance, education, and smart wealth management. It serves as a reminder that no matter where we come from, what matters is where we're going and how we get there. So, what was Jack's secret to successful wealth management? Well, Jack's wealth management strategy was a combination of 4 key elements: investment choices, risk management, financial planning, and discipline. Let's break this down. Firstly, Jack was no stranger to making smart investment choices. He didn't just throw his money at the latest hot stocks or into whatever was trendy at the moment. Oh no, he had a much more strategic approach. Jack took the time to thoroughly research and understand each investment opportunity. His portfolio was a diverse mix of stocks, bonds, and real estate, ensuring that his wealth was spread across different sectors and markets. This allowed Jack to take advantage of various economic conditions and trends. Secondly, Jack was a big believer in risk management. He understood that every investment carries some level of risk, and he never lost sight of that fact. He always ensured that the potential returns justified the risks involved. Jack also made sure to not put all his eggs in one basket, thereby reducing the impact of a single bad investment. Thirdly, financial planning was a crucial part of Jack's wealth management strategy. He had clear financial goals, and he planned his investments with those goals in mind. Whether it was buying a house, starting a business, or planning for retirement, Jack had a plan for it all. Finally, and perhaps most importantly, Jack was disciplined. He wasn't swayed by the ups and downs of the market. He didn't panic when things went south, nor did he get overexcited when things were going well. Instead, he stayed focused on his long-term goals and stuck to his plan, even when it was tempting to deviate. Jack's wealth management strategy was not about making a quick buck. It was about careful planning, smart investment choices, and maintaining discipline, even in the face of adversity. He knew that wealth management was a marathon, not a sprint. Jack's story teaches us that wealth management is not about quick riches, but about careful planning and smart choices. So what are the key takeaways from Jack's success story? As we've seen, Jack's journey to financial success wasn't a stroke of luck or a get-rich-quick scheme. It was a structured process, a testament to the power of effective wealth management. Let's distill this process into 4 key points: financial planning, smart investments, risk management, and discipline. First off, financial planning. Jack's story emphasizes the importance of having a clear financial roadmap. He knew his goals, understood his current financial status, and planned his way to reach those goals. This allowed him to allocate his resources strategically, ensuring he was always moving in the right direction. Remember, a goal without a plan is just a wish. Next up, smart investments. Jack didn't just throw his money into the latest fad. He made informed decisions based on careful research and analysis. He diversified his portfolio, spreading his investments across different asset classes to maximize returns and minimize risks. Remember, the goal of investment is not merely to accumulate wealth, but to grow it. The third point is risk management. Jack understood that all investments come with a certain level of risk. However, instead of avoiding risks altogether, he managed them. He balanced his high-risk, high-return investments with safer, lower-yield ones. He also kept an emergency fund as a safety net. Remember, risk is a part of the game. The key is not to eliminate it, but to manage it effectively. Finally, discipline. This is perhaps the most crucial yet most overlooked element of wealth management. Jack stuck to his plan even when things didn't go as expected. He didn't let short-term setbacks derail his long-term goals. He understood that wealth management is not about making a quick buck, but about consistent growth over time. Remember, discipline is what separates the successful from the unsuccessful. To sum it all up, effective wealth management is a combination of thoughtful planning, informed investing, diligent risk management, and unwavering discipline. It's about making strategic decisions based on your financial goals, not on whims or trends. It's about understanding that wealth creation is not a sprint, but a marathon. Wealth management is a journey, not a destination. It's about making the right choices consistently. Now that you've learned the secrets of effective wealth management, what's your next step? The answer is simple: start your journey. It's never too early or too late to begin. Whether you're a fresh graduate with your first paycheck, a mid-career professional, or someone considering retirement, it's time to take control of your financial future. The world of wealth management may sound daunting, but it doesn't have to be. Start by setting clear financial goals. What do you want to achieve? Perhaps it's a comfortable retirement, a dream home, or financial security for your family. Once you have your goals in mind, it's time to develop a strategy. There are countless resources available to help you on this journey. A plethora of books, podcasts, and online courses offer insights into investment strategies, budgeting tips, and financial planning. Some of the most popular include The Intelligent Investor by Benjamin Graham, the Bigger Pockets podcast for real estate enthusiasts, and Coursera's Personal and Family Financial Planning course. Consider reaching out to a financial advisor. These professionals can provide personalized advice tailored to your unique circumstances and goals. They can help you understand complex financial concepts, navigate tax laws, and make informed investment decisions. Join a community of like-minded individuals. There are many online forums and social media groups where people share their experiences, successes, and lessons learned. These communities can be a source of inspiration, motivation, and support as you embark on your wealth management journey. Remember to be patient. Building wealth is not a sprint, but a marathon. It requires time, discipline, and consistency. There will be ups and downs, but stay committed to your goals. Keep learning, keep growing, and keep moving forward. Finally, take action. Knowledge is power, but it's only useful if you apply it. Don't let fear or uncertainty hold you back. As the saying goes, the best time to plant a tree was 20 years ago. The second best time is now. Remember, the road to financial freedom starts with a single step. It's time to take that step today.